Why most investors lose money, and the simple fix nobody talks about. Let me ask you something. You're at a garage sale. You spot a painting. The seller says, $50. You don't know anything about art. So what do? You probably pull out your phone, Google it, and within 60 seconds, you know if that painting is worth $50 or $50,000. Now here's the wild part. Most people who invest their hard-earned money in the stock market, money they worked years for, never do that same basic check. They buy a stock because it's going up. Because a friend mentioned it. Because some guy on Reddit was hyped about it. They never ask the one question that separates investors who build wealth from investors who just gamble: what is this thing actually worth? That question has a real answer. And today, I'm going to show you exactly how to find it. Welcome back. If you're new here, this channel is about making smart money moves in plain English. No jargon. No fluff. Just real stuff that actually works. Today we're talking about intrinsic value. Now, I know what you might be thinking. That sounds complicated. Or, that's for Wall Street guys in suits, not regular people like me. Wrong. This concept is actually one of the simplest ideas in investing once someone breaks it down the right way. And once you truly get it, the way you look at every stock, every business, every investment will change permanently. We're going to cover 4 things today: why stock price and stock value are two totally different things, what intrinsic value actually is, in plain, everyday terms, a simple framework you can use to estimate it yourself, and why the gap between price and value is where all the money is made. Let's get into it. The price versus value trap, and why most investors fall for it. Here's something most people never think about. When you walk into a car dealership, the sticker price on the window is not the car's value. It's just the price the dealership wants. The actual value of that car depends on the mileage, the condition, the model year, what similar cars are selling for privately. You know this. You'd negotiate. But when people buy stocks, they throw all of that logic out the window. They see a stock price go from $40 to $60, and they think, it's going up, it must be good. They see a price drop from $60 to $40 and think, it's falling, something's wrong. But here's the truth: a falling price can mean a great opportunity, and a rising price can mean a terrible one. It all depends on what the business is actually worth. Let me give you a real-world analogy that makes this crystal clear. Imagine you're shopping for a house in your neighborhood. A house comes on the market. The asking price is $500,000. Now, does that mean it's worth $500,000? Not automatically. You'd want to know, how many bedrooms? How many bathrooms? What's the neighborhood like? What did similar houses sell for last year? Is there anything wrong with it that would cost money to fix? You're doing an analysis. You're trying to figure out the real value before deciding if the price is fair. Stocks are no different. A stock is just a tiny piece of a real business. When you buy a share of Apple, or Ford, or any other company, you own a fraction of that company's future income. Period. That's it. So the only real question is, how much future income is this business going to produce, and what is that worth to me today? Here's where most people get tripped up. They watch the stock price tick up and down on their phone all day and they think that is the story. It's not. The stock price is just what someone was willing to pay at any given moment. It's driven by emotion, news headlines, fear, greed, hype. The real value, intrinsic value, is driven by cash. By what the business actually earns and generates for its owners. And those two numbers, price and value, they can be wildly different. There was a period in 2022 when stocks like Amazon were trading at half their price from the year before. Did Amazon suddenly become half as valuable as a business? Did they lose half their customers? Did their warehouses disappear? No. The business was largely the same. The price just panicked. And people who understood the difference between price and value saw that as an opportunity, not a catastrophe. This is the mindset shift. And it changes everything. So what is intrinsic value? The simple version, alright. Let's talk about what intrinsic value actually is. Forget the textbook definition for a second. Here's the most human way I can explain it. Intrinsic value is the answer to this question. If I owned this entire business, and I was going to collect all the cash it makes from now until it closes forever, how much would all that cash be worth to me today? That's it. That's the whole idea. Now let's break that down piece by piece, because there are two parts to it that most people miss. Part 1, it's about cash, not profit. A lot of companies report big profits on paper but don't actually generate much real cash. Why? Because accounting has all these rules, depreciation, amortization, creative revenue recognition, that can make a business look more profitable than it really is on a cash basis. What we care about is free cash flow. That's the actual money left over after the company has paid for everything it needs to keep operating, salaries, equipment, maintenance, the whole thing. What's left over? That's real. That's what counts. Think of it like your paycheck. Your salary might be $80,000 a year. But after rent, car payments, groceries, utilities, what do you actually have left at the end of the month? That's your free cash flow. That's what you can actually use, save, or invest. The rest is already spoken for. Same idea with a business. Part 2, future cash is worth less than today's cash. This one trips people up. But I promise it makes total sense once you see it. Would you rather have $100 today, or $100 5 years from now? Today, obviously. Because you could invest that $100 right now and have more than $100 in 5 years. Also, inflation eats away at money over time. $100 buys less stuff 5 years from now than it does today. So when we're calculating intrinsic value, we have to take the future cash flows and discount them, basically shrink them, to reflect what they're actually worth in today's dollars. This is called discounting, and the rate you use is called the discount rate. Think of it as your minimum acceptable return. Most serious investors use somewhere between 8% and 12% as their discount rate. The further in the future the cash is, the more it gets shrunk. That's why a business that generates a lot of cash right now is often more valuable than one promising huge profits 10 or 15 years from now. The far future stuff is uncertain and discounted heavily. Let me give you a super simple example. Imagine a vending machine business. It's boring. It's simple. But every year, it reliably puts $10,000 in cash in your pocket. Not revenue, actual cash, after all the machine maintenance and restocking costs. Now imagine you can buy that business. What would you pay for it? Well, if you require a 10% annual return on your money, you'd be willing to pay $100,000. Because $10,000 a year is 10% of $100,000. Makes sense. But what if that vending machine is growing, adding new machines in new locations, and you expect the cash to grow at 5% a year for the next decade? Suddenly the business is worth more than $100,000, because you're going to get more and more cash each year going forward. That's the core of a proper intrinsic value calculation. You're just trying to figure out, given how much cash this generates and how it'll grow, what's a fair price to pay. How to actually run the numbers, without a finance degree. Okay. So now you understand what intrinsic value is. Let's talk about how to estimate it. I want to walk you through this with a simple fictional business. Let's call it Greenfield Coffee, a regional chain with loyal customers, steady growth, and consistent cash flow. Exactly the kind of boring, predictable business that makes for a great valuation exercise. Step 1. Find the free cash flow. Let's say Greenfield Coffee generates $20 million in free cash flow this year. You find this on the company's cash flow statement. Look for cash from operations and subtract capital expenditures. That's your starting number. Step 2. Estimate how fast that cash is growing. Greenfield is a stable, mature business. It's not a startup swinging for the fences. We'll assume a conservative 5% growth rate per year for the next 10 years. This is the part where people get in trouble. They get overly optimistic. Be conservative. It's better to underestimate and be pleasantly surprised than to overestimate and lose money. Step 3. Project cash flows over 10 years. Just multiply out. Year 1, $21 million. Year 2, $22 million. Year 3, $23 million. And so on, growing at 5% per year out to year 10. By year 10, you're looking at about $32.6 million in free cash flow. Step 4. Discount each year back to today. Remember, future money is worth less. Using a 10% discount rate, year 1's $21 million is worth about $19 million today. Year 5's cash is worth about $16 million today. Year 10's cash is worth about $12.5 million today. You add all 10 of those discounted numbers up, and you get the present value of your 10-year cash flows. For Greenfield, that comes out to roughly $160 million. Step 5. Add the terminal value. Here's the thing most people forget. The business doesn't just stop after year 10. It keeps running, keeps generating cash. The terminal value is meant to capture all of that future value beyond the 10-year window. We calculate it using a simple formula. Take the year 10 cash flow, grow it by a small long-term rate, let's say 2.5%, then divide by the discount rate minus that growth rate. So, $32.6 million times 1.025 divided by 0.10 minus 0.025 equals about $446 million. That's the terminal value at the end of year 10. But we still need to discount that back to today. Discounting $446 million over 10 years at 10% gives us about $172 million in today's dollars. Step 6. Add it all together. $160 million, 10-year cash flows, plus $172 million, terminal value, equals roughly $332 million in intrinsic value. Now here's the critical question. What is Greenfield Coffee's current market capitalization, the total price the stock market is putting on the whole business? If it's trading at $450 million, that's overvalued. The market is paying a premium that the fundamentals don't support. If it's trading at $280 million, that's potentially a great opportunity. You'd be buying $332 million worth of value for only $280 million. That gap between market price and intrinsic value. That's where the money is made. Now, a huge caveat here, and I want to be really honest with you. This is an estimate. Not a formula that spits out a perfect answer. The inputs matter enormously. Change the growth rate by 1%. Change the discount rate by a point or two. The output shifts significantly. Which is why smart investors don't buy when the stock is trading right at intrinsic value. They want a cushion. A buffer. A "what if I'm wrong" zone. That buffer is called the margin of safety, and we'll talk about exactly what that looks like in just a minute. The margin of safety, your protection against being wrong. Here's something I want you to tattoo on the inside of your eyelids. All financial projections are wrong. The best you can do is be usefully wrong. Nobody knows for certain how any business will perform over the next 10 years. Industries shift. Competition emerges. Recessions hit. Management makes dumb decisions. A pandemic shuts everything down. Your intrinsic value estimate is only as good as the assumptions going into it. And since none of us has a crystal ball, every estimate carries real uncertainty. This is why smart investors always insist on buying at a significant discount to their estimated intrinsic value. That discount is your margin of safety. Think of it like this. You're driving across a bridge. An engineer tells you the bridge can safely hold 10,000 pounds. Would you try to drive a 9,900-pound truck across it? No way. You'd want some breathing room. You'd take the truck that weighs 7,000 pounds and feel comfortable. Same principle in investing. If you calculate intrinsic value at $100 per share, you don't buy at $95 or even $85. You wait until it trades at $65 or $70. That gap, that 30 to 35% discount, gives you protection if your assumptions were too optimistic, and extra upside if the business performs even better than you expected. The margin of safety is what separates investing from speculating. And here's the uncomfortable truth most people don't want to hear: finding stocks that trade well below their intrinsic value is hard. It takes patience. The market is reasonably efficient most of the time, meaning most stocks trade somewhere close to what they're actually worth. But there are moments, market crashes, industry panics, unfair sell-offs after a single bad earnings report, when a great business gets thrown out with the bathwater. And if you've already done your homework on that business and you know its intrinsic value, those moments are gifts. The investors who make generational wealth aren't necessarily smarter than everyone else. They're more patient. They do the work. And then they wait for the right pitch. The simple takeaway: what to do with this starting today. Look, I'm not going to pretend that mastering this overnight is easy. It takes practice. But here's what you can start doing right now, even if you're just getting started. Step 1. Stop looking at stock prices as the story. The price is just a number someone is willing to transact at today. It tells you nothing about value. Train yourself to ask, what is this business actually worth? Step 2. Start reading cash flow statements. Not earnings per share. Not revenue. Cash from operations minus capital expenditures. That's the real number. Get in the habit of finding it for any company you're considering buying. Step 3. Run rough, conservative estimates. You don't need a perfect model. You need a ballpark. Pick a conservative growth rate, lower than you think is realistic. Use a discount rate of 10%. See what number you get. Compare it to the market cap. Step 4. Only buy with a margin of safety. If your estimate and the market price are very close, pass. Wait. There will be a better moment. If the stock is trading at a meaningful discount to your estimate, now you're talking. Step 5. Be patient. This is the hardest part. Most people can't do step 5, which is why this strategy works for the ones who can. The market rewards patience above almost everything else. You don't need to find great opportunities every day. You just need to find a handful of great ones in your lifetime and have the discipline to act on them and hold on. Here's your challenge for this week. Pick one company you're curious about. It can be a business you use every day, a retailer, a restaurant chain, a tech platform. Look up its free cash flow. Run a rough DCF estimate using the steps we talked about today. Then look up its current market cap and compare. You don't have to buy anything. Just do the exercise. Because the moment you go through that process for the first time, you will never look at a stock the same way again. If this video helped you think differently about investing, do me a favor, hit the like button. It genuinely helps more people find this channel. And drop a comment below telling me, what company are you going to analyze first? I read every single one. Subscribe if you haven't already. We put out new videos every week on building real wealth in real life. I'll see you in the next one. Take care.